All right, let's talk about some options ideas that let you hold on to your money in these crazy times in VXX and UVXY. Coming up next on the Short Vols show, and we can discuss some ways to save you a little bit of money coming up right now.
And the skies of November turn blue, but the load of iron ore 26,000 tons more than the Edmund Fitzgerald wave empty.
And here we are back, and I made a really short intro because I didn't want to get jammed up by the federales again for putting a copyrighted song in. So here we are back, and I know a lot of people are frustrated who have gotten kind of crushed lately with volatility expanding and contracting and whatnot, and it almost seems like timing when stuff is going to come in is becoming as hard as it usually is to time when vol is going to spike. Now, we are kind of on the tail end of a big VIX event here. At least I think it's the tail end. We'll have to wait till further out in time to confirm that. But if we look at a 20-day chart here, behind me you can see it kind of looks like we're sort of wrapping it up here maybe. We see this big event. Let's actually back it up more. Let's go to 180 days just to get some real perspective here. Okay, so that way you can see it a little bit better. And as I talk, I'm actually going to shrink my screen here a little bit so you can see it even better. But basically, we had a big spiky spike, which came in around the 10th of October. And we haven't reached that height again. And it looks like we're slowly moving lower here. After one big spike, it came back, then another spike, and then a smaller one today, which has pretty much come all the way back. It looks like VIX up 17 cents on the day-to-day. So, but you never know when you're going to get another spike, and it's been hard to make money just shorting things, and you don't really want to be naked short these things because it takes a lot of capital, A, and B, it's hard to sleep at night when this thing could pop way up against you. So, you know, options to the rescue. Of course, options allow you to put on whatever position you want. Whatever you think is going to happen, you can customize a position for that. And right now, it's kind of a situation where, well, I want to be short a little bit. I definitely want to be short, but I don't want to be paying for the right to be short, because it could go sideways to up for a while longer. So yeah, I want to be short. I certainly don't want to be long. I know it's slowly going to go lower here, but once again, I don't want to buy expensive puts that are going to cost me a whole lot and slowly decay on me. And then if I get a pop, all of a sudden I lose money and it's costing me money every day. I'd rather have them pay me to be short, and there's some ways we can do that. One of the ways we can do that is with a calendar spread, but another way that I've been doing it is with a diagonal. Now, we have what some people would call the poor man's covered call that we use in equity sometimes, and what we do is we buy one option, which is sort of like a surrogate for buying the stock. Like we'll buy a deep call as a surrogate for buying the stock, and then we will sell an out-of-the-money call. So it's kind of like a covered call, but instead of buying the stock, you're buying a deep call. So for example, an example of that in UVXY might be to buy now this is not the option trade I'm suggesting. I'm just explaining what a poor man's covered call is, okay? So it might be to buy the Jan 30 call and sell a, let's say a Nov 28 50 call, or I'm sorry, Nov 28 sorry, I'm on VXX. Sorry, you might be to buy a Jan 30 call and sell like a Nov 60 call against it. Or maybe let's make a better example. What if I were to buy a Jan 50 call, and we'll just do this just for example. Buy a Jan 50 call, right? And then sell, let's say, a D60 call against it. Okay, so that trade is kind of like a poor man's covered call. You could say the Jan 50 call is really stock and is really like a surrogate for owning the stock or the ETP, and the D60 call is like selling a call against that stock that you own. Well, the opposite of that is to buy a deep put and sell another put against it. So for example, let me show you an example of what I mean. UVXY, if we want a trade that is going to make us money if it goes down, and we want to have that trade on for a little while, but we don't want to be paying for the right to be short these deltas or to make money if it goes down, what we could do is a sort of a diagonal, which is what I've done here. So what I did was I bought a Jan 50 put, okay, and then against it, I sold a Nov 47 put, okay. So, so here's the trade: buy Jan 50 put, sell Nov 47 put. So in a sense, it's like a married put. It's as if you're selling the stock, and then you're selling a put against it, so that as it moves, it's almost like a vertical, but it's across 2 months. So you've bought the month that decays more slowly, and you've sold the month that's decaying more quickly. So the Greeks on this trade, let me exaggerate it so we can take a look at the Greeks. But an interesting thing about a trade like this is that it is a long Vega trade. So what that means is that if we get a spike, even though we are short some deltas, if we get a spike in UVXY, well, what happens when we spike? Well, the implied volatility options gets cranked up. So even though the delta would be against us when we spike, it gets offset a bit because we're long some Vega, okay? And there's different ways of thinking about this trade. So for example, if we were to do this, I have another couple small example trades on here, so let me turn those off. But if I go in the Analyze tab here, and if I were to do this trade 73 times, let's say 75 times, okay, that would get me short 900 deltas, collecting $300 a day in theta, and so now 75 times would cost quite a bit of money. Let's see how much that would cost. So that would cost $50,000 in buying power for this trade. But you're short, so you're short 900 deltas. So each dollar that UVXY goes down, you make $900. Each dollar goes up, you lose $900. But as you see, as you go up higher and higher, that number becomes less and less. But also you're long 450 Vega here. So if you get a spike, the volatility is probably going to crank like 10 points, if not more. And so for each point, you're going to make $450. So the Vega for a spike offsets your short delta a little bit. So that kind of cancels itself out, which is pretty neat. And then, but to the downside, as we creep down, your volatility might come in a little bit. So you might lose a little bit on Vega, but you'll make up for it in your delta. And as we creep toward this, now we're at 58. As we creep toward this 47 strike, we probably won't get to 47 in 14 days. We might, but there's a good chance we won't either. And so in a sense, what you're really doing with this position is you are just buying a nice put in January to get you short, but you're selling the Nov 47 put to finance it. Okay, so you've bought a put and you've secured your short deltas in this trade, so you'll make money if it goes down. But to pay for that put, you've got this Nov put sold against it. And the Nov one, like I said, is probably going to go out worthless, and it's just going to help finance your trade for you. And it's always nice to have something financing your trade for you. It's lowering your cost basis. The other thing with this put here is 14 days. Okay, 14 days come and go. Well, you could roll this Nov put out. So you could say, okay, like in a week, I could say, okay, well, what I'll do is I will go ahead and I will buy that NOV put back. I will buy the NOV put back, and I will sell. If we've rolled down significantly, maybe I'll even just pick a lower strike. Like maybe I'll go out 2 more weeks, and I will go ahead and sell a 30 NOV 47 put. Now, the markets are really wide now, so it's not representative of the actual markets very much. But if we've rolled down a little bit, I might move down to selling a 46 put or a 45 put. Either way, you're going to have an option that's decaying a lot more rapidly, helping to finance that Jan short delta. And when you look at this trade, it can be helpful to look at it as the 2 options separately and see if we never get to that NOV put, like if we never make it to 47 before NOV expiration in 14 days, then essentially you can pretty much discount the long deltas caused by that put if you never get to that strike. So, for example, so let's illustrate this trade just as 2 separate options for a second here. So, let's say we sold NOV 47 put. We sold 10 of them, let's say. And we bought the Jan 50 put. And let's say we bought 10 Jan 50 puts. And I'm just putting them in as separate trades right now so that I can analyze them separately. So this position together has a delta, if you did it 10 times, of short 121 deltas, collecting $40 a day. But if you never get, if we don't make it down to 47, like right now we're at 57, I'm sorry, we're at 58, so we're $11 away. So if we don't make it to 47 in 2 weeks, then actually we're really short almost 289 deltas. If this put goes out worthless, then it's just helped us finance all this stuff, and we're actually shorter than our sheets show us. And so the best thing that can happen with this position is we slowly move lower. And that's kind of what we expect to happen over time. The most likely thing we expect to happen is for us to slowly move lower. Now, in the meantime, this can spike and bounce around a little bit, but the theta that we're collecting every day will help us weather that storm. So instead of just being long puts and every day it goes up, paying that decay, losing a little money every single time it rips up, this way we are, worst comes to worst, and UVXY does nothing tomorrow, you're still making $40. And if it goes up $1, well, you lost $100 on the delta, but you still made $40 on the theta. So you always got this little cushion of income coming in. Now, I'll tell you what, when stuff's bouncing around and it feels frustrating for weeks, it's kind of moving sideways and nothing's happening, having a little cushion of money coming in every day is a great thing to have. Gives you peace of mind. In a position like this, maybe you do it 10 times. It's not a huge position, but it keeps you engaged. You still have a position on, but you're protecting your money. You're not sitting there trying to guess exactly when it's going to make a big move and down and, having to pay decay every day and, hoping that it's going to happen before your puts expire. No, you're collecting money every day. So you don't really, if nothing happens, you collect a little money, big deal. It's at least going to pay and if it moves up $1 and just stops, well, 2 days later, you've made back that money because you've collected $80 in theta, right? Or 3 days later. Then if the next day it moves back down $1, then you've made the money back plus collect. So collecting a little money every day offsets a lot of problems, and it's going to allow you to stay in the game and hold on to that money. And like I said, the greatest thing that could happen is this thing just slowly rolls down towards 47, but never really gets there. And then the 47 puts expire worthless, and the Jan 50 puts become more and more valuable. And once again, if we did start rolling towards 47, before these 47 puts expire, you could buy them back in and roll them out to like a lower put on another month. So you could buy this 47 put back and sell like the DECE 40 puts or something. You keep that Jan 50 put as your surrogate short stock always in play, and you just keep selling other stuff against it to help finance it. This is a smarter way of going about things, and it's going to keep you in the game longer, and it's not like the clock is always ticking against you. In fact, time is sort of on your side. And we know that short the VIX or short these VIX ETPs, in the end, we're going to win as long as we can stay in the game long enough. And collecting a little theta is going to keep us in the game a little bit longer. So think about this. Another trade we could just talk about is just a straight up calendar spread, buying the same option and selling the same option. And here, your strike selection is important. We want to pick a strike where we think this is heading towards. And so we're going to in these VIX ETPs, we're thinking that this is going to move lower at some point, and so we want to pick a strike that's lower than the at-the-money strike right now to put a calendar on. And some people will try to leg into these calendars, like maybe you buy the long put first, and then look for a down move to leg into the calendar, but you don't even need to do that. You can just go ahead and buy a calendar. So for example, we could look at maybe the DEES Jan. Right now, this is 58. We could look at maybe the DEES Jan 48 spread, or maybe even the DEES Jan 45 put spread. So put spread versus call spread isn't a huge deal here. You want to make sure that I would think that you don't want to be short too deep of a call, because it might get assigned on you if the put next to it becomes worthless. So maybe look at, let's just take a look at the DEES Jan 40 put spread in UVXY here for a second. So you buy the Jan 40 put for $3. Okay, and then you sell the DEES 40 put for $1. Okay, so and this is showing the market, the midpoint being $1.26 per spread. So if we do the spread 10 times, so let's see, if we do it 8 times the spread, it's going to be about $1,000. Okay, so we do this vertical 8 times, costs us $1,000. And let's take a look at what it does to our delta. This is going to give us short 20 deltas, okay? So no big shakes, right? You're short 20 deltas. So if we were to do this 5 times as much for $5,000, so if we were to do it 40 times, so for $5,000, you're short 100 deltas in UVXY. So each bucket goes down, you make $100, okay? You're collecting $25 a day in theta. You're long 74 vega. So if you get the pop, okay, maybe you put this trade on when vols come in a teeny bit, right? If you get the pop, then the delta is going to go against you, but the vega that you're long, the 74 vega you're long, is going to go for you, and they're going to offset each other a little bit. To the downside, same thing. Your delta is going to kick in, but the vega may come in a little bit. Now, you know it's only going to come in to a certain point, and then it's going to stop coming in, but your delta is going to continue. So, and remember, as we walk towards the 40 strike, this is going to work more and more for you as you get closer to that 40 strike. In fact, as we get to the 40 strike, the delta is going to go to what? It's going to go to 0, right? So as this cruises down towards 40, your delta is going to be less and less until at the 40 strike, you're kind of centered on the position. And if it starts to go lower than there, then you might want to readjust and maybe take it off and pick a lower strike. But for now, it's going to take a while for it to get to the 40 strike. So you put the position on like this, you just hang out. If you want to collect a little more decay, you might pick a position to sell, or a month to sell this a little bit closer to expiration, like maybe this no 40 put. This way you would be, let's see, this way the no 40 put is almost worthless right now, so it doesn't make a whole lot of sense to this trade. If you're going to do it with no, if you want to do a little bit higher strike, like maybe the 45 strike, maybe, where you're actually getting a little bit more play. So for the 45 strike, let's see, if you were to do it 40 times, it would cost you more than 10 grand, but it would cost you 20 grand. So you could do it maybe like 20 times if you were going to use a little bit closer strike. And this way, you know, you're collecting a little bit more theta, but you're going to have to babysit the position a little bit more because your deltas are going to move around a little bit more. It's not going to last as long. You're closer to expiration, and it's going to be a little bit more funky to manage, but you are collecting more theta. If you move it out farther, it's going to be a little bit easier to manage, but you're going to collect a little less theta. But it's something that you can leave on for a few weeks and not think about that much. And once again, great, because your delta is short, which you want, and you're collecting money, which you want. So both things kind of going in your favor. And if you do get a pop, you are along a little bit of vega to offset that pop. And you've got time on your side, like I said, once again. Each day that goes by, if nothing happens, you're still collecting money. And when the weekends come, you're collecting money too. So think about these trades as ways to stay in the game when maybe we're not in contango, maybe we're in backwardation, maybe we're just flat like we've been the last couple of sessions. Maybe stuff is all over the place. Think about, instead of just being long costly puts that are going to decay all over the place, or straight put spread, which is also going to decay to some extent, but is better. Think about maybe some of these diagonals or calendar spreads to mix it up and kind of use the options to customize your position based on what you need and what your expectations are of UVXY as time moves forward. Anyway, I hope this was helpful to you. If you have any questions, feel free to reach out to me. I hope I'm explaining it clearly. It can be kind of confusing using this Thinkorswim setup sometimes, but if you have any questions, feel free to ping me, leave a comment. I'm reachable on my email, which is listed somewhere below there. And thanks for watching, and we'll see you next time. And until then, happy trading, and good luck to you this week.
That big ship and true was a bone to be chewed when the gales of November came hurrying.